Hey everybody, I hope everyone is doing well and had a good day. In this video, we're going to review the E-mini S&P 500 5-minute chart for Thursday, May 21st, 2026. On the daily chart, we have the strong bull trend, and then we talked about the micro channel for the bears yesterday. Structurally, it's basically a spike in channel, more clearly seen on maybe the 30-minute or 60-minute chart. And it's a double bottom testing the low of the May 12th bar. In the strong trend, the bulls are expecting this to be a minor reversal, possibly a double bottom bull flag before there's trend resumption. Here's the information we had going into the day. A strong bull breakout bar yesterday, and that's trapping traders to the left. A couple of things about that. One, the high of the 19th, which was Tuesday, is probably support. We have a bull breakout closing above the high of that bar. And after the micro channel, with a bar that's not a very good buy signal bar, there were probably traders selling above Tuesday's high, scaling in higher, expecting this micro channel to at least pause and hesitate and get maybe a second leg sideways to down before the bulls get back to trend resumption. So the market may pull back here, and the expectation is that there's probably traders buying at the high of Tuesday, this doji bar, which is also around the midpoint of yesterday, which was a bull trend day. As far as today, it's a decent buy signal bar for the bulls. There might be traders buying above yesterday's high, expecting or at least looking for trend resumption. But after the micro channel, there might be sellers somewhere above. And I have this marked because if we look at, let's see, the 60-minute chart, we talked about this maybe yesterday or a couple days ago. The gap down is a spike. It's a spike in channel bear trend with at least 3 or 4 legs down to support, which we talked about on the daily chart. This is the more detailed version on the 60-minute chart. And a common magnet is the start of the channel. We've had increasing buying pressure, strong bull bar here, a couple of bull bars here and here. The channel is evolving into a trading range. We broke above a major lower high. And so a magnet is the start of the channel. Breakout, the gap down, pull back, and then this is the start of the channel down. And that's a magnet, which I have marked on the 5-minute chart as it was relevant today. Okay, for the 5-minute chart, there was a gap down going into the day. And so the structure yesterday, it's a spike in channel, bull trend, with many legs up in the channel. Bull channel line acting as resistance. The first target for the bears is the start of the channel. So this tight channel is the spike. Here's the pullback, and here's the channel. And the channel more likely to evolve into a trading range. So these legs up eventually become legs in a trading range, and then the gap down immediately testing that price, the start of the channel. So gap down with a follow-through bar for the bears. Strong enough gap down that you know that there are trapped traders above. If any trader, in theory, is buying at the close of yesterday, they're getting trapped by the gap down. And that increases the probability that the bears will get a second leg down. So you can see the gap down as a bear breakout. Maybe there's a hesitation or a pause as we're testing support, but the expectation is that gaps behave just like breakouts, and breakouts usually get second legs. And then more follow-through selling for the bears on the open. So that's good for the bears. Gap down with follow-through selling. Probably sellers above the first reversal attempt by the bulls will probably be minor and fail and lead to either a trading range or a bear flag and then a second leg down. But through here, on the open, the market sold off on 1, rallied on 1, down on 2, up on 3, and then down on 3 and up on 4 and down on 4 again. So you know that on a smaller time frame, This is a bear channel. We're getting lower highs, lower lows, and then a trend line break when 4 went above the high of 3. So we have 3 or 4 legs down in a channel, and then a bull breakout above 3. And that means there's probably traders buying below 4. I talk about stairs patterns from time to time. If you look at a smaller time frame chart, the traders buying below bar 2 made money. The traders buying below 3 made money. And so there's probably traders buying below 4, and they're expected to make money as the channel gets more weak and goes more sideways, evolving into a trading range. Also, based on where the market is, it's far below the moving average, and the bars are going more and more sideways, which means if you're selling down here, the only way you can sell far below the moving average is if there's sustained momentum. Logically, the only way you can sell far below the average price is if the bears are controlling the price and the time. However, the market's going sideways for 4 bars on the open here, so it's a trading range far below the moving average. The traders selling, with their premise being momentum, they really don't have a strong premise right now because the first 4 bars of the day are overlapping and going more sideways. So selling here is not ideal. And then bar 5 is a big bull breakout bar. It's reversion to the mean being the moving average. We were above the moving average at yesterday's close. We gapped below, but went sideways, and now we're getting a breakout back up to the average price. The moving average is just one measure of average, and that's where bar 5 is testing. Now the question is, will the gap down and follow through get a second leg down? 5 is a strong bar. It's a strong breakout bar, but it's probably around a 50% pullback of the sell-off here, which is usually resistance. The traders selling will scale in and at least be able to avoid a loss about 80% of the time. But 5 is a strong enough breakout bar that there are trapped traders down below. Traders selling above 3, 4, or selling the close of 4, selling anywhere down here, are trapped by the bull breakout. That creates support below. So we have basically a big down with the gap down and big up with the bar 5 breakout. Big confusion. It's a trading range. Gap down and then basically gap up, bull breakout. So probably sellers somewhere above, maybe breakout points. Maybe that's a best fit breakout point here. 77 low, 79, 80, and 81. Traders buying here got trapped by the gap down breakout, and that creates resistance above. Through here, the bulls bar 5 breakout got follow through. On a smaller time frame, it's a breakout, implied pullback on the 5-minute, but again, smaller time frame, probably a pullback and then a channel for 3 legs up. This is a truncated wedge. You have a rally on 6, pullback, rally on 7, pullback, rally on 8, but the rally on 8 did not break out above the swing high on bar 7. You can see the market's reaction to resistance on bar 7, tail above 6, tail above 7 as it's trying to break out above the prior bar. Traders are selling into the close instead of buying. Overall, it's probably a trading range. Like I said, big down, big up, and now we're testing an area of resistance. So as far as bar 8 goes, it's a strong looking bull bar, but it's an inside bar and it's just below resistance. So there might be more traders selling above bar 8. And then 9 went outside down. It's a strong breakout bar. Context is okay for selling. You have this spike and channel structure, so you know the channel is probably going to evolve into a trading range. And then bigger picture, the gap down gets a deep pullback, but still expected to get a second leg because of the trapped traders. Also in a trading range, traders don't want to buy high, they want to sell high. So the bulls, they have this momentum, pretty good micro channel for the bulls, but instead of buying near resistance, the bulls might buy a pullback down closer to support. That could be these breakout points, the bar 3 and 4 high, It could be the low of bar 5, but it's not up here. If anything, it's going to be lower, which creates room to the downside for the bears selling. So basically, spike and channel structure, bear breakout bar on bar 9, reasonable bar to exit longs below and to sell for a scalp. But it looks like a trading range, so traders are probably scalping here. 10, a good follow-through bar for the bears. Traders selling the close bar 9 or selling below bar 9. It looks like they made 1 unit of risk in just 1 bar, and that's probably going to attract some profit taking. Strong enough sell-off, it's probably going to test at least a little bit lower, but I do expect support somewhere around here, the low of bar 5, the start of this bull breakout. And if the market does break out to a new low, there's probably traders buying below bar 4. Micro channel for the bears, first reversal up will probably fail. It's really interesting. I should have said that here too. Micro channel for the bulls, first reversal down probably will fail, but in this case, the bears succeeded in getting a reversal, and that creates trapped traders. Why? Because usually micro channels, the first pullback leads to trend resumption and a test of the highs. So a limit order bull might buy the first pullback, like below bar 8, and they get trapped on the reversal down. And that creates resistance at the low of bar 8. So I'm going to keep that horizontal line drawn there. But same principle applies here. Micro channel for the bears, first reversal up will probably be minor, lead to sellers above and a second leg down. 12 is a decent bull bar. It's a bull breakout bar at support. Relatively small bar compared to the micro channel. So still probably sellers above and a second leg down likely, but 12 is not ideal for selling above. Maybe 12 gets a small second leg before the bears get their second leg down. There's some follow through on 13. Maybe that's what the second leg will be for the bulls on 12. Now it's about a 50% pullback of the sell-off, also testing the moving average, which was resistance. And maybe the bears are getting their second leg down here. It is a micro channel from 11 to 13, so there might be buyers below 13 and some hesitation before the bears get their second leg. Another bar added to the micro channel. There were buyers below. Micro channel will probably hesitate, find buyers below and hesitate, go kind of sideways before going immediately down. But this looks like a minor reversal after the sell-off, and the sell-off 9 through 11 will probably get a second leg down. 15 is a bad stop order buy, probably sellers above, maybe even sell the close on the bar. The bears trying to get their second leg down. Now it's a second entry long. It's a double bottom for the bulls above 17. Some traders will buy. I think it's okay to exit shorts above 17. And if you're buying, you're taking a lower probability trade. It's a limit order market, fairly tight trading range over the past 5, 6, or 7 bars. So there might be more traders selling above. The moving average has been acting as resistance. And if you're buying above 17, you're buying just below that resistance in a limit order market. 18 testing that resistance, the bar 13 high, and the moving average. Possible that it's a low 2 short for the bears, bear breakout, pullback, low 1, a second reversal attempt, and then maybe a low 2 short, which 19 is a decent signal bar for. So bear breakout, low 1, low 2. Some traders will sell 19, looking for a second leg down and a test of the low of the day. But again, a fairly tight trading range through here. So 19, if you're entering on a stop order, you're entering in the middle of this tight trading range, and that's not ideal. $20 a bear breakout, testing the low of the day. Now the bears have a couple legs down. You can call it a wedge, even though it doesn't look like a wedge because it's a breakout attempt below a double bottom being 11 and 16, and then 20 breaking below that double bottom. So that's 3 pushes down, 1, 2, 3. So let's see if the bear breakout can get a follow-through bar. It's already a problem that the bear breakout closed above the breakout point. It's a sign of weakness in the breakout. Also, look at the context. It's a lot of overlapping bars. I said it's a big down, big up, open, and now you're getting a lot of overlapping bars. You know the market's in a trading range, and 80% of breakout attempts of trading ranges fail, which means doing the opposite and fading breakout attempts, betting that they will fail and revert to the mean, the middle of the range, is a better strategy than betting on breakouts. So in other words, instead of selling below 4, betting on the bear breakout here, it's probably more wise to look to buy down here. And the structure is good. If you're buying below 4, you're betting that the bear breakout below the trading range fails and its 3 pushes down. And then you can see all the buying on 21, bears taking profits and bulls buying. So outside up 21, strong enough bar that it definitely trapped traders down lower in the range, and it may get a second leg up. The problem is that it's getting confusing. Now it's 3 pushes up, 1, 2, 3. So 21, there might be sellers above 21, and it may get a deeper pullback. Pause bar, 22. Market starts to pull back as we're at resistance in this tight, relatively tight trading range. And then 25, a bear breakout, but testing closer to support. Support exists as a range. It's not just one line. So I have the low of bar 5 drawn as support, but really there's support. Every time the market tests here, it bounces, fails to break below it a couple times here, reverses up, fails to break below here, reverses up. So this is a relevant level of support as well. So the support really exists as a range anywhere between here, here, and here. It looks like traders are buying. And in a trading range, that's what you want to do. You want to buy low and sell high. So 25 is a good breakout bar for the bears, but the context is not very good because 21 trapped traders below, and now we're testing support once again. 26, a bull breakout bar, or possibly an inside bar. It's a trend bar, but it's completely inside 25. There might be sellers above 25 because it's an inside bar. It's a non-breakout bar. Inside bars in trading ranges are range compression. Inside bars in general are range compression. It's a lower high and a higher low. On the smaller time frame, it's a trading range. And because of that, there's probably traders selling above 25 and scaling in higher, betting on more of the same. In other words, betting that the trading range here will continue. And in a decent micro channel, 26, 27, and 28. But 28 is testing that resistance, the breakout point of bar 8, created by the breakout on 9 and 10. So there might be sellers here, but the micro channel is strong enough up here that, I say it all the time. I said it here and here. When there's a micro channel, the first reversal usually fails and leads to an attempt at trend resumption, a second leg. So enough momentum here that the first reversal attempt will probably fail. Better if you can sell a second entry instead. So the first reversal below 29 will probably find buyers below. It's a relatively small bar. The momentum for the bulls is pretty good. It'll probably get a second leg. So there might be more buyers below 29 on 30 and maybe at the moving average as well. Quick scalp for the bulls. Whenever there's high probability setup, it's bad risk reward. So the bulls can buy below bar 29, but their stop is all the way down here. And they're scalping out of the trade here on bar 31 as it breaks out to a new high above 29. So there's probably sellers up here now. The market continued to go sideways. Now 33 is a second entry short. First entry short below 29. It failed, ran the stop, and then 33 a second entry short. But it is in the upper third of the trading range and still hovering around this breakout point. So a reasonable sell below 33. You can exit longs below 33 and sell to go short below 33. But it's still a trading range. So if you are selling, you are scalping. And the bears get their stop order scalp with 34 and 35. 35, the tail on the bar as it approaches support once again. It might go a little bit lower. It's a micro channel. The first reversal up will probably fail. And the micro channel down will probably get a second leg. Doji inside bar, another bar added to the micro channel. The same logic applies. There's probably sellers above 36, and a second leg down is expected. So the first reversal attempt on 37 is probably only minor. It's a bear breakout, a pullback, and then a second leg and a test of the low. The bar 35 low is expected here. For the bulls, it's also a micro channel up 35, 36, 37. So probably buyers below for a second leg. Also, this was a micro channel, which only got a small second leg. It may be getting a more complex pullback and then a bigger second leg to the upside. In other words, breakout, tight channel, pullback, and then maybe a second leg test of the highs here. The bears get their second leg on bar 38. So again, breakout, pullback, second leg, but buyers at the 35 low expected, and then continuing to go sideways. It's a spike in channel structure. Now we have 3 legs down in the buy zone of this rally. So the bears are probably buying below 38 and 35. That creates support below on bar 40. So probably traders buying below 40, even though it's an outside down bear breakout bar. Again, it's a spike in channel structure. Bear spike, pullback, and then a second leg and third leg probably going to test back up near these highs before falling for the same distance down, a measured move down. Also, for day structure at this point in the day, there's a couple of thoughts I have here. One, it sort of has a shape of a triangle, which is breakout mode. Market's in breakout mode. The range is getting tighter and tighter, and eventually it's going to break out to one side or the other. As far as average daily range goes, ADR is about 60 points. The recent ADR is about 60 points, and the day's range at this point is about 35 points, which means the day's range today could double, it could break out and double, go for a measured move up or down, and still be about an average range. So it's possible that we get a contracting triangle in the first half of the day and then a breakout and then probably more sideways. Usually days that have this much trading range behavior don't become trend days. Whenever there's a day with this much trading range price action and the range of the day is about half of the recent daily average, one of the common patterns you get is a trending trading range day, where there's a trading range on the open and then a bull breakout or a bear breakout and then more trading range. So basically, the possibilities that are common are a trading range in the first half, a bear breakout, and then another trading range. So it's a upper trading range, lower trading range, trending trading range day. And then the opposite of that is a bull trending trading range day, where there's a trading range on the open, a bull breakout, and then a trading range later in the day, lower trading range, bull breakout, and upper trading range, trending trading range day. Those are the most likely outcomes for the second half of the day. It's always possible that the range stays in this small of a range, but usually you expect the day's range to be about average, and right now it's about half. So the range is probably going to grow and possibly even double. The tight trading range here continuing, the market continues to go sideways in breakout mode. Better to wait for the breakout. The range is so tight here, it's not really worth trading. And if you are trading, it's a limit order market. There's traders selling above bars and buying below bars. Bar 45, we finally get the bull breakout. 45 is unlike all the bars to the left except maybe bar 5. It's about the same size as bar 5, but it's a big bull breakout bar. You know that traders selling here for any reason, like I said, if it's a limit order market, there's limit order bears selling here, expecting the trading range to continue. There's a bear trend line here in the triangle, so they're selling here, expecting maybe a test of the bull trend line or lower prices in the range, but instead they get trapped on 45. Even the traders selling up here at this breakout point, they get trapped into a losing trade. And the traders selling at the current high of the day or the breakout point I had highlighted earlier, they get triggered into a short position. But the momentum was so strong on 45 that the expectation is at least a little more sideways to up. In other words, 45 is a strong enough breakout that it'll probably get a second leg up. And then it immediately gets a measured move up on 46. Now 45 and 46 is a bigger breakout and follow through. Strong breakout far above the bars to the left in this triangle. The bulls will probably get a second leg and possibly a measured move up based on the height of this breakout and follow through, but also I talked about possibly a measured move based on the range, the trading range in the first half of the day. And that takes you up here to the high of May 15th, which I think I talked about earlier in the day, but if we look at the 30-minute chart, maybe it's that spike in channel bear trend, and this was the start of the channel, and that's a typical magnet and area expected to be an area of resistance. Also, one more thing worth mentioning as we get into this bull breakout, it's possible that it's a third leg up. Leg 1, pull back, leg 2, pull back, and then leg 3. So kind of a dueling lines pattern, bull channel, and resistance at the start of the bear channel. I said a measured move up, maybe a 60% chance the bulls get a measured move up based on this breakout and follow through. And there's a magnet above, which we just talked about. A trading range bar on 47, it's testing yesterday's high. I said there might be buyers above yesterday's high because it's a strong bull signal bar. It looks like we're pausing here and finding some resistance, and that makes sense as we look to the left. Overall, this looks like a trading range, but the momentum up here is so strong that the first reversal or any hesitation is probably minor. Until there's a decent trend line break for the bears, you can expect more sideways to up. So it's always in long here, probably traders buying below 47. And the same applies for 48. And the bulls micro channel continued here, accelerating as it gets closer to resistance and then testing it on 52. But really still no reason to sell here. It's always in long, better to be looking to buy. It's a strong bull breakout. The only thing to be cautious of here is, again, that dueling lines I'm trying to show. It's 3 legs up. It's 3 big legs up here. We can see it on the 5-minute chart. So there's a bull channel line here, and then that May 15th high resistance as well. So we have to pay attention to the market behavior. Will the bulls get a successful breakout here, or will they fail to break out? 53, it's a really strong breakout bar. It's closing far above this resistance line. And that's really good for the bulls. Now the question is, will the bull breakout get follow through? And then 54, a strong rejection of that bull breakout. 54 is a strong bear reversal bar closing on its low. For the bulls, if you're long for any reason, 54 is a reasonable bar to exit your longs below, because there's too much risk that we pull back here, as it's 3 big legs up in an overall wide trading range structure. The trading range is, I'm talking about all of these bars being part of the trading range. And when the trading range is this wide, you're going to have trends in both directions. There's a spike in channel, bear trend down here, and then a pretty broad bull channel here with periods of down or sideways to down. But when it's 3 legs up to the top of a trading range, as strong as the rally looks, in this context, I think it makes sense to respect a strong bear trend bar like 54 and exit longs below it. And if you're selling, I think it's okay to sell below 54 for a swing. There's so much momentum to the upside here that the first reversal will probably be minor and lead to more sideways before going straight down. But 55, another strong bear bar, so good for the bears. Reversal and follow through, second leg down, likely. Traders buying for any reason. If you bought the close 53, you're trapped by 54 and 55, and that is disappointing, and that creates resistance above. So hesitation, maybe sideways, is likely because the rally is strong, but 54 and 55 is a strong enough reversal and trendline break that it'll probably get a second leg down of its own. And then the bear micro channel continued. The structure, it's a couple of pushes down. It's testing below a strong bull bar, which is support. Maybe we rally here, but the micro channel grew to about 5 bars. And there's probably sellers above, and again, second leg down, likely after the micro channel down. So buying here, buying 58 or 59, not really ideal. The bulls are getting their sideways price action here. It's not going straight down, but for the bears, this is not all that disappointing. If you sold, it's not a very deep pullback. It's just a minor reversal before an expected second leg down. So continuing to go sideways through here. The market's in a tight trading range. Once again, it's a limit order market. Sellers above 56 and 60 likely. So as 63 is breaking out above those bars, there's probably sellers above here. Also, the high of May 15th is a major resistance level, and we can see the reaction to it on the 5-minute chart. Also, bar 63 is a third push up. It doesn't look like a wedge, but functionally, it's basically a breakout of a double top. The double top being the 56 high and the 60 high. So 63 is attempting to break out above that double top, and then on the next bar, it failed in a big way. It was basically a wedge. The point I'm getting at is that it's a bear breakout, 3 reversal attempts, and then the bears get their second leg. So 54, 55, bear breakout, pullback, wedge bear flag, and then second leg down, 64. 64, strong enough bar. The first reversal up may fail, but we are testing yesterday's high, and there may be support here. And also there's a bear channel line, so there might be traders buying, although buying is not ideal when there's such strong momentum on a bar like 64. Also, the next layer of support might be all the way down here. I'll change this to this breakout point, this breakout point. Remember back here when 45 and 46 broke out, this level was resistance. Traders selling here got trapped. The previous high of the day was resistance. The market hesitated there for maybe a fraction of a bar, but then broke out, and that traps traders and creates support as well. So between these two horizontal lines is probably support. Huge bear breakout bar, 65. 65 is a great bar for the bears, but in this context, you look to the left, and again, it's big up, big down. You know the market is in a trading range, and it's testing that in between these support levels that I was just referring to. And when 65 is such a big bar, the traders who were selling earlier, maybe below 54 or anywhere through here, are getting a windfall of profits. It's basically a gift in their direction. If you sold 54, are you really going to hold on to your trade? Or when the market gives you such a big bar, an above average, very big bar in your direction into support on a trading range day, do you really want to hold short, or do you want to take your profits? 65 for the bears. If you're selling 65, you're forced to sell a huge bar. So It's a big bar, big risk, and it's forcing you to sell at an area of support. This was a strong bull breakout, trapping traders to the left here, and the expectation is that there are going to be buyers in this area. 66 bull reversal bar, relatively small bar compared to 65, but strong enough bar closing on its high that if you're short, you can probably exit above 66 and be okay with that, because the risk is that one of the risks is that this is a second leg trap. Leg 1, pullback, leg 2, and into an area of support. So 66, a bull bar closing on its high, might be reason enough to exit your short position. As far as buying 66, it's a small bar after a big bear breakout. It's a low probability buy, but you have good risk reward. And then a good entry bar for the bulls reversal and follow through. That's strong enough to trap traders and to get a second leg up. So the first reversal down will probably fail. But still, big up, big down, big up as we continue to go sideways here. And we are approaching resistance to the left. So why is this resistance? Again, support and resistance exist in a range. It's not just one bar. So I'll use the low of 58 and maybe the low of 63 as the range. Why are these lines resistance now? Because the traders at this time, the market is in a tight trading range, and it's a limit order market, and traders buying low and selling high and scalping are making money. So they're going to keep doing that. Sell above here on 63 and scalp and make money. Traders will buy below 63, not a very good stop order sell signal bar. They'll scale in lower, like below 58, and they'll try to maybe exit with a profit. But in this case, they get trapped, maybe even avoided a loss with the tail on 65. You can see that this is interesting, worth talking about. If you bought below 63 and bought more at the low of 58, your average entry price is the purple line here. And bar 65 tested that line, which means, I'll go back through it again, the bull's doing reasonable things here, buying at the low of 63, scaling in below 58. They were able to avoid a loss if they were quick and put their exit order to sell out of their position at their average entry between the low of 58 and the low of 63. 65 gave them that brief opportunity to exit. And it looks like a lot of traders sold there as the tail on 65 tested that area and then found a lot of sellers. Bears are always selling, and then bulls who were disappointed by the breakout on 64 were also selling, and that contributed to the big bar on 65. The reason I'm bringing that up is now the market is testing this area once again on 68. It's a pretty strong micro channel. It's probably going to get a second leg, but as we approach resistance, the market may start to go more sideways and reverse back down here. And you can see it already on 69, a much smaller bar and overlapping bar, and then through here, the bar's going much more sideways and much smaller than these bigger bull bars through here. So it looks like the market's continuing to go more sideways through here. Limit order market, buyers below 72, sellers above 72, likely. So buyers come in below, sellers come in above, and the tight trading range continued here into the end of the day. Okay, that's going to be it for today's end of day review. For more information on price action fundamentals and how to trade price action, please visit the Brooks Trading Course link in the description of this video. All right, thanks again, everybody, for tuning in today, and I hope everybody has a good night.